Hi guys, Mark Shaw's in the Pattern Trader here. I wanted to talk to you about a trade that we sent to our subscribers last night in the pound versus the Japanese yen. Also, we've had a ton of new subscribers sign up, so I wanted to thank everybody who is just joining. For those who are just joining, I wanted to talk to you a little bit about this trade, what my thinking was behind the trade, how we look to trade the market, and how we're also very different than how most Forex signal providers or EAs trade the market. So first off, you'll notice that we're looking just at a clean chart. So what I mean by a clean chart, there are no indicators here. There's no moving averages, there's no stochastics, there's no noise. We're just looking at price and time. So this to me gives me a clear view of where the market's headed and where it may be headed next. So the first thing I look at in a market is what is the trading condition? And to my mind, the market really can go up, down, or sideways. There is also two added nuances. It can be trending from a bull market to a bear market, or a bear market to a bull market. So there's actually five conditions or phases of the market. So the first thing I look to do when I open up a chart like this is I look to evaluate what condition or phase the market is. So for the last 3, 4, 5 months, the market has been in a trending phase. And when we look at trending markets like this, we have a couple ways that we look to get in a market. One is we look to isolate key reversals. So once we've determined what the direction of the trend is, in this case it was an upward direction, then we look for key reversals like this, or like this, or like this, where the market makes a new low and then goes ahead and closes in the opposite direction, effectively flushing out all the weak players and then setting up for a continuation in the trend. But recently we've been noticing that there's been a change in the condition of this market, and we saw the emergence of a very bearish appearance of this double top right here. So you can see right here you have two clear peaks in this market where it started to hit a resistance phase and set up for a potential downfall. And last week we did short this market right here. We were able to take advantage of this huge windfall to the downside. And the market has been coiling now for the last week or so in this phase here. So the first thing we look to do is identify what is the phase or the trend in the market. And if it's in a turning phase, we look for patterns. So it could be a double top or a descending wedge or anything you'll find in your typical textbook in any Forex technical analysis chart book. But then we add various layers of sophistication and other criteria that we need in order to confirm our trade. So the next thing we look for is, once we've identified the pattern, which we did here, the double top, now we look for a coil that will then release, and think of it like a beach ball underwater. So the more pressure that builds, the more you hold that beach ball underwater, the more when you release it, it's going to just erupt into a gusher. That's the same kind of principle that I'm looking for in the market. That once we put our trades in, I'm looking, once that trade is triggered, to go from one level to the other very quickly. If it goes the other direction, I'm going to fold my hand and get rid of it. So in this instance, when we put in the trade last night, after the day prior session, we had this key reversal. And let me just draw all of this in for you so that you understand. This is a key reversal price action that we saw yesterday. So now we have two criteria. We have a pattern, the double top, and now we have this inside day bar or key reversal bar, what we call an insurance bar. An insurance bar tells us that if we're correct, that the prices should just explode from one level to the other. So basically what we did was we strategically placed our sell stop in the British pound versus the Japanese yen at 185.84. So right under yesterday's close, we strategically placed a sell stop. And then we put our stop loss protection above that at 186.27. Now, the way we figure out our stop losses is that we actually anchor it to the previous day's close. So you can see the close was right here. And my thinking is if the trade goes in our favor and then starts going back the other way through the unchanged level, then we don't want it anymore. So the real key is selecting a level where the market will not just stop you out too quickly because of all the noise and still keep you in if the trade is good, or if it is bad, you want to be stopped out. So the key is, where do you put that stop loss level? And that's, one of the secret sauces of our trading methodology that we're going to be happy to share with you in a series of free tutorials that you'll be able to sign up on our website for very soon. So again, we put our sell stop here at 185.84. We put our stop loss at 186.27. It got pretty close last night. It went to about 186.15. And then, of course, it just fell the other way. And we were able to take the meat of this trade out right here at 184.27. We bagged 157 pips on this trade alone. So this is basically what that trade looked like here. Let me just share this with you real quick. So this is what the trade looked like. The entry order was a sell stop at 185.84. We had a stop loss at 186.27. Our take profit was 184.27. So we ended up making 157 pips on this trade. So that worked out to be a risk-reward ratio of 3.65. So our risk-to-reward ratio was 3.65. Okay, and what does the risk-reward mean? Risk-reward is the number of pips made, this 157, relative to our risk. So in this case, if we got stopped out, we would have lost 43 pips. And we ended up making 157 pips. So our risk-reward ratio was right here, 3.65. So with the risk-reward ratio of 2 to 3 to 1, you can make up to 17 losing trades out of a string of 25 trades and still be a big winner. And I think this is what really separates us from most Forex traders. So we look again at the daily price charts for big moves that extend for days, weeks, or months on end, and we look to take out the bigger trades. In this case, we managed to get 3.65 risk to reward on only one trade just overnight. And again, I think this is what really separates our trading, our style of trading, from the way most retail traders trade. So most retail traders will sit in front of a 5-minute or 10-minute or 15-minute chart with a moving average or a stochastic crossover, and they'll look to extract 15 to 25 pips on a given trade. But then, of course, you have to risk 10 to 15 to 20 pips to get that 15 to 25. You've also got the spread to overcome. You've got commissions. And so you end up having to be correct on 80 to 90% of your trades. And that's why most traders will fail in the long term. They frankly just don't have a strategy that nets them enough pips on a winning trade to overcome all the losers along the way. So again, if you'd like to follow our trades absolutely free for the next 2 weeks, go ahead and click up on the link below, and we'll be happy to send that to you. We'll also send you our free tutorials. And until next time, I wish you a healthy and prosperous trading day. Take care. Bye-bye.